How to earn from option trading. Options trading allows investors to speculate on the future direction of the stock market or specific securities, such as stocks or bonds. Options contracts give you the option, but not the obligation, to buy or sell an underlying asset at a specific price by a certain date. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about how to earn from option trading. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. What are the options? Options are tradable contracts that allow investors to speculate on whether the price of an asset will rise or fall at a future date, with no obligation to purchase the asset in issue. Options may appear paradoxical at first glance, but they aren't as complicated as they seem. To comprehend choices, you only need to grasp a few fundamental phrases. Derivative. Options are considered derivatives, which means they draw their value from another asset. Consider stock options, in which the price of a specific stock determines the value of the option contract. Call option and put option. A call option allows you to buy a security at a predetermined price on a specific date, whereas a put option allows you to sell a security at a later date and price. Strike price and expiration date. The predetermined price specified above is known as a strike price. Traders have until the contract's expiration date to exercise the option at the strike price. Premium. The cost of purchasing an option is known as a premium, and it depends on the cost and worth of the underlying security. Intrinsic and extrinsic values. The intrinsic value of an option contract is the difference between its strike price and the underlying asset's current price. Extrinsic value refers to elements other than those considered in intrinsic value that influence the premium, such as how long the option is valid for. In the money and out of the money. An option is classified as in the money, profitable, or out of the money, unprofitable, based on the price of the underlying securities and the amount of time until expiration. How options pricing works. Let's use an example to help make sense of all this stuff. Consider a stock that now trades at INR 100 per share. When trading options, you pay a premium up front and then have the choice to buy this fictional stock, call options, or sell it, put options, at the predetermined strike price by the expiration date. A lower strike price has a higher intrinsic value for call options since the options contract allows you to buy the stock at a lower price than it is currently trading for. If the stock price remains at INR 100, your call options are in the money, allowing you to purchase the shares at a discount. In contrast, a higher strike price has more intrinsic value for put options since it lets you sell the stock at a higher price than it is now selling at. Your options are in the money if the stock remains at INR 100, but you can sell it at a higher strike price, say INR 110. How options trading works. You can use a variety of options trading methods, from simple approaches to complex trades. In general, trading call options is a means to wager on growing prices, whereas trading put options is a way to bet on falling prices. Options contracts allow investors to buy or sell a minimum of 100 shares of stock or other assets. However, there is no commitment to execute options if the trade is not profitable. When an investor decides not to exercise his or her options, the only money he or she stands to lose is the contract premium. As a result, options trading can be a reasonably inexpensive way to speculate on a wide variety of asset types. To break even on call and put options, the underlying asset's price must rise or fall by an amount equal to the premium paid plus the strike price in rupees. Here's how to benefit from call options. When the underlying asset's price exceeds the break-even point, you can sell the call option, known as closing your position, and earn the difference between the premium you paid and the current premium. Put options. When the asset's price falls below the break-even point, you can sell the options contract to close your position and collect the difference between the premium you paid and the current premium. Alternatively, you have the opportunity to sell the underlying asset at the agreed-upon strike price. If the asset's price swings in the opposite direction as desired for a call or put option, you simply let the contract expire, and your losses are limited to the amount you paid for the option. Options trading methods can get extremely complex when skilled traders combine two or more calls or puts with distinct strike prices or expiration dates. Options trading pros. Option trading combines specificity and flexibility. Traders must select a certain strike price and expiration date, which lock in the price they expect an asset will reach over a given duration. However, they also have the freedom to see how things go during that time, and if they're wrong, they're not compelled to make a trade. Because options contracts have an expiration date that can range from a few days to many months, options trading methods appeal to traders looking to limit their exposure to a certain asset for a shorter length of time. Options traders must actively monitor the price of the underlying asset to determine whether they are in the money or wish to exercise their options. Options trading cons. Options trading is not suitable for everyone, particularly those who prefer a hands-off approach to investment. Options trading requires you to make 3 decisions: direction, price, and time, which adds more complexity to the investment process than some people desire. To make money from options trading, you must create price alerts and monitor the market to determine when your deal will become profitable. You should also be aware of the hazards and trading costs that can accumulate while using various options techniques. While many brokers have abolished costs for trading stocks or exchange-traded funds, ETFs, the same fees still apply to options. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.